Property taxes suck. There's few things I dislike more than giving the government my money. But having an understanding of how property taxes work in South Carolina will make you a smarter home shopper or homeowner. And most people, to include many real estate agents and lenders, don't actually know how taxes are calculated. So stay tuned to learn the secrets. Hey, what's up YouTube? It's Shawn, your Charleston realtor. Today we're going to talk about everyone's favorite topic, taxes. And not just any type of taxes, we're going to discuss property taxes. There's some serious misunderstanding on how they're calculated and what goes into them here in South Carolina. First, it would mean the world to me if you could like and subscribe. As a new content creator, this goes a long way. So fortunately, South Carolina ranks among the top 10 states with the lowest property taxes in the entire country. If you've owned a home elsewhere, it's likely you're going to be shocked, in a good way, when you see your property tax bill here in South Carolina. Even so, there are 3 factors that affect your tax bill here. That is your assessed value, your assessment rate, and the millage rate. As I discuss each of these factors, I'll also give you some pointers on how you can minimize your yearly tax obligation. Before we get to the individual factors, let's talk about property taxes in a general sense. These taxes are levied by the local county government and are paid once a year. Your tax bill will be escrowed, so whoever is servicing your loan will try to estimate your tax bill, and then divide that number by 12, so you're paying into your escrow account an even amount each month. In January of each year, your tax bill is due and is paid directly from your escrow account. Most homeowners might get a bill in the mail saying what their property taxes are, but as long as the mortgage is escrowed, which almost all of them are, they won't have to pay directly to the county. So what are these taxes used for? Well, a good chunk are used for county operations, municipal bonds, public amenities, public schools, and individual city municipalities. But more on that later. But the point I'm making is that taxes are paid to the county, and then from there they're dispersed to different areas to keep all parts of the local government afloat. So the first thing your tax bill depends on is the assessed value of your home. The government likes to call this the fair market value, except that they get to determine what is fair. And the county actually determines what the value of your home is by hiring an appraisal. And just like an appraisal for a normal residential purchase, a licensed appraiser will develop the value of your home based on one of the 3 appraisal methods. However, they are not going into your house, though I have heard stories of appraisers looking at photos on Zillow and the MLS, so be careful in that regard. Now, I'm in Charleston, and there's 3 major counties in our area: Berkeley, Dorchester, and Charleston County. You can also include Colleton County here if you want. In order to see what the current assessed value for any home is, just go to the county's website and search by address. I'll leave links to these search engines in the description below. So when you purchase a home, you know exactly what your tax bill will be for that year. But here's where so many people get tripped up and what lenders and real estate agents don't tell you, usually because they don't know better. When the deed is transferred, i.e. you buy the house, you trip this procedure called the Assessable Transfer of Interest, or ATI for short. This means that the county is going to reassess the home you just purchased by December 31st of that year, meaning that the following year's tax bill will be higher. Think about it. If a home was being taxed at a fair market value of $200,000 and then it was sold for $400,000, then you bet that the county wants to tax it at that higher rate. It's this reason, the ATI, that typically causes property taxes to rise in the second year of home ownership. By the way, this will almost always catch your escrow company by surprise. So going into the 3rd calendar year of home ownership, there's a good chance your monthly payment will go up, sometimes substantially, depending on what property taxes used to be. So what happens when you already own a home and your property has already been assessed after the purchase? Well, it's reassessed every 5th year after that. At this point, you're pretty protected. The county cannot increase your taxes more than 15% in any 5-year period, as long as you maintain ownership and don't transfer the deed. Now there's some other things that might affect the assessed value and might not abide by the 15% cap, such as the addition of new structures on the property or major renovations. But for the most part, this is not applicable to most homeowners. Just know that your assessed value can, and usually will, go up the year after you purchase a home. And then it'll only go up by a maximum of 15% every 5 years thereafter. I also want to touch on the homestead exemption here. If you're 65 or older, or legally blind, or fully disabled, then you can apply for a homestead exemption. This will remove the first $50,000 in assessed value, making your taxes lower. So for instance, if your fair market value was $400,000, then you'd only be taxed on $350,000. But wait, what if you don't agree with the county's assessment of your home's value? Well, you can actually dispute this with the county. There's a lot of helpful resources out there to help you win against the county, but it's not really the point of this video. Most homeowners don't bother with the appeal process, and as a result, potentially lose out on tax savings. Most counties usually require you to file an appeal within 90 days of receiving your new assessment notice. Now, the second factor that affects your property taxes is your assessment rate. For residential property in South Carolina, there's only 2 assessments, 6% and 4%. The 4% rate is reserved only for your primary home. Every other residential real property, from investment properties to second homes to vacant land, is taxed at a 6% rate. Now, the counties are tricky and are definitely looking for your money. They will assume that every home purchase is actually an investment property, even if you're intending to live in the property yourself. So in order to get the 4% tax rate, you must file an application with the county. Each county has different rules and requirements, but as a rule, you'll typically need a proof that you're living in the property. So think a utility bill with your name on it, or your driver's license, etc. There are exemptions to this for military. Usually you just need to provide a copy of your orders. However, this 4% tax application is really easy for new homeowners to forget because you can't file it right away. In fact, you usually have to wait a month or so for deeds to be recorded with the county before they even know that you own the place. Or in the case of Charleston County, 3 months, because the recorder of deeds is stuck in the 18th century. I might be exaggerating, but a judge actually had to step in last year because Charleston County deeds were being recorded so slowly. Alright, so you might be asking, wow, Shawn, the difference between 4% and 6% doesn't really seem that much. Is it really that big of a deal? And the answer is a resounding yes. It actually is a huge deal, but not for the reason you might think. With a 4% property tax rate and a completed primary residence application, you are actually exempt from the school district millage rate, which usually accounts for half of your taxes. Which leads us into the last factor that affects your taxes. That is the millage rate. Now, I'm not going to get into the history of the mill and what the actual conversion between a mill and a dollar is, but that's not the point of this video. But essentially, the millage rate is going to be a fraction that you multiply by your tax value in order to come up with your actual property tax number. This is an incredibly convoluted process, but as a rule of thumb, assume your millage rate is 0.300. That's a good starting point. It's usually anywhere between 0.250 and 0.300, but let's err on the side of being conservative. But let me show you just how convoluted your actual number will be, and that's going to be determined by the county. Take, for instance, everything that goes into determining your millage rate in Charleston County. You can see that the county's base millage rate is 0.05560. They break this down to show you what each of this actually goes to. It includes county operations, county bonds, park and rec operations, and the local college. The school millage rate is 0.158. This is pretty steep and accounts for over half of the millage rate. But this is what keeps Charleston County schools going. And then look at each of the municipalities. If you're incorporated into a municipality, then you're going to be paying higher taxes to that municipality. So if you're both in Charleston County and formally incorporated into Charleston City, you're going to pay 0.0843. But take a look at some of the other cities. Mount Pleasant taxes are actually half of Charleston at 0.0393, while Sullivan's Island is at a whopping 0.588. That's almost 9 times higher than Charleston City. Now, other millages are on a case-by-case basis. So certain fire districts or school boards are going to have individual millage rates levied on top of everything. The point I'm trying to make is that your millage rate is really dependent on the neighborhood or the county or the city you're in and everything that goes with that. No 2 cities, no 2 neighborhoods are alike. So let's put everything together. Let's say, for instance, you just bought a home on James Island. Let's say it was $400,000 and you're confident that the county will assess you at $400,000. But you're going to live in it, so you qualify for that 4% exemption. So let's multiply $400,000 by 0.04 and you're left with a taxable value of $16,000. Now remember when I said the millage rate was typically 0.300, just as a rule of thumb? Let's use that here. But you also qualify for the exemption of the school district millage, so let's subtract 0.15, which is roughly half. So your total millage rate is 0.15. We're left with $400,000 times 0.04 times 0.15, which is $2,400. Your total tax bill for that year is $2,400. Divide that by 12, and you can reasonably expect to pay around $200 each month toward your taxes in your escrow account. But wait, what happens if that $400,000 was actually an investment property and not a primary residence? Well, the numbers are actually a little simpler. That would be $400,000 times 0.06 times 0.3, because you're not only taxed at a higher 6% rate, but you also have to pay that school district millage rate. Your yearly tax bill in this case would be $7,200. Divide that by 12 and you're left with roughly $600 per month going to taxes. So the moral of the story is that if you live in the home by yourself, your tax bill will usually be about 1/3 of the tax bill of someone who used it as an investment property. You just need to file for the exemption. I say again, you just need to file for the 4% exemption. For this James Island example, I also calculated the actual millage rate, and it was 0.2915, so pretty darn close to 0.3. If you're interested in calculating the millage rate yourself, I'll leave a link in the description for South Carolina millage rates by county. So that's everything that goes into determining your property taxes here in South Carolina. It wasn't too painful, was it? Now go forth and impress your friends at the bar with your newfound knowledge. And as always, if you want to talk more about Charleston taxes or Charleston real estate, please let me know. My contact information is in the description below, and I'll see you in the next video.